G'day everyone, welcome to this weekend general update for the 30th of June, and befitting the end of the financial year. We've had really a very pivotal week in markets, particularly on Friday night. I'm feeling pretty confident now to say that I think the US correction in stocks in general is over, and I also think we've probably seen the bottom in gold stocks as well. Maybe not so much in the price of gold, but as I've covered on numerous occasions before, we often see the price of stocks turn up or turn down 3 to 6 weeks in advance of the price of gold. So certainly some very good signs for gold stocks on Friday night. So let's have a look at what was a really important week. And because this aspect is so critical, I'm going to start and just have a little bit of a look at bond markets. Now, hopefully your eyes won't roll back and switch off, because this really is incredibly important, not only to stock markets, but really for all our financial futures. So just a little bit of an understanding here is really quite important. And I guess the other key thing is too that when you've got major disruptions to the existing trends, as we've seen with gold over the last 18 months to 2 years, and as I believe we're about to see in the bond market, then that creates opportunities, because it causes massive reversals and it causes massive volatility, which is always opportunistic for traders. So let's have a look at global bond markets, just a quick summary. First of all, there's been a 30-year bubble in people buying bonds, government bonds, corporate bonds, and even junk bonds. And because those prices have gone up, then yields have gone down to extremely low levels, and everyone's aware of the fact that in America and Europe and Japan, that interest rates have been effectively zero for quite some time, and that's why. But this 30-year bond bubble is now dead. It's finished, it's rolled over, and we're going to see bond prices fall. They're already falling. And the fact that bond prices fall causes bond yields or interest rates to go up. So there's an inverse relationship there. And we've seen interest rates overseas start to edge up. Not in Australia yet. In fact, there's still discussion about the fact that we might get another interest rate cut here because our economy is so weak, but certainly yields overseas are getting upward pressure. But the critical factor here for us, particularly with respect to the stock market, is how bond prices fall. Now, there's two ways it can happen. It can be orderly or it can be disorderly. Now, I believe central banks, in fact I think it's inevitable that central banks will eventually lose control of global asset markets, be that stocks, bonds, currencies, whatever it is. They will eventually lose control, but it's not yet. And in fact, I believe it's quite a few years away, because there's lots of things that they can continue doing that'll keep the party going. Now, let's have a look at two scenarios. The first one is that bond prices fall sharply. In other words, the whole system gets very disorderly, very untidy, and the results of that would be that mortgage interest rates, particularly in America, which is absolutely dependent on the recovery of the housing market for their economic recovery, mortgage interest rates are going to rise too quickly, and that's going to kill the housing recovery, and that is going to absolutely put the American economy back where it was 2 or 3 years ago. And I can assure you they don't want that. The second negative consequence is that the US government debt to GDP ratio is going to get rapidly worse. It's already bad enough, but it would just get rapidly worse, because in effect the interest that they've got to pay to overseas funders who've been funding their deficit for 30 years just keeps going up and up and up. So the American government and the Fed have a vested interest in keeping those interest rates down. The third consequence would be that Europe would fall apart. You would see bank failures escalating. We'd be back in 2008 again. In fact, in some ways, we'd be worse than 2008, because there's been a lot more debt created since 2008. You know, things have not improved. They've been made worse. So if the bond market were to fall in an uncontrolled manner, then you'd pretty much see Europe fall apart, you'd see the euro fall apart. It would be an absolute disaster. And stock markets as a consequence would crash, because the whole global financial system is really sitting on a knife edge, and anything that disturbs that pretty delicate balance is just going to bring the whole house of cards down. So if bond prices are allowed to fall sharply, then the scenario is very, very ugly, and I think it would be worse than 2008. And that's why I don't think it's going to happen. Now, the alternative is that bond prices fall in a controlled manner. In other words, central banks keep stimulating for a period of time to hold this whole house of cards up for a longer period. Now, the consequence of that would be that the US housing market has time to adjust. Yes, interest rates would start to rise over time, but they do it gradually, and there'd be in a natural adjustment process. That would obviously place less immediate pressure on government debt, so not as much drama there. I believe stock markets would actually benefit from a controlled fall in the price of bonds or the rise in the yields, because money's going to start coming out of the bond market because people will be fearful that the people that have bought in the last couple of years have bought in at the high price and they've accepted a very low yield. Now, as prices start to fall, then they're still getting a low yield on their investment, but they're starting to lose significantly on capital gain. And some bond markets around the world are actually off 10-15% already. So people aren't going to sit there and get 1 or 2% interest and be losing 10 or 20% capital gain. So money's going to come out of the bond market, and it's got to go somewhere. So part of it is certainly going to go into the stock market as long as things are still orderly. So I think it's actually a positive for stock markets. Now, I believe this is the most likely option to occur because everything around the world runs on self-interest. And it's very much in the self-interest of banks, central banks and governments to basically keep this stimulus going. They just don't have a choice, because otherwise the whole system is just going to fall apart. Now, I believe eventually this whole system will fall apart. But look, that could be 3 years, 5 years, could be 10 years away. So there's no point in worrying about it. You've just got to get on and invest and make the best of what you've got at the time. When the system eventually does completely fall apart, the signals will be very obvious well in advance. So that's the good news. So hopefully that gives you a really good backdrop, because the next 6 months to 12 months is going to be absolutely critical for your wealth building. Now let's have a look at the S&P. In fact, just before we go to the S&P, I will just have a look at these. This is the 30-year Treasury bond yield in America. So we're looking here at about the last 5 or 6 years of history, and you can see the last time that the 30-year bond yield got down to a really low level, or in 2008 it got down to a really low level, so interest rates on the 10-year bond were around 2.5%. We got down there again in June of last year and again in July of last year. And so we've been, basically interest rates have been trading in a range between 2.5% and about 3.5% since September 2011, so nearly 2 years. Now you can see just in the last few days, I'll just tighten in on that, you'll see in the last few days that rates have moved up above 3.5% for the first time in a long, long time. So I think that's certainly a significant move, and it's one that I believe the Fed will do something about. They've made so much effort about stimulating, keeping interest rates down, trying to boost the economy. I don't believe that they can back off on QE3 despite everything that's been said in the last week or two. Now, just one other quick chart I want to have a look at that's important. This is the VIX index, the volatility index, and you can see that whilst it has spiked up a little bit in the last few weeks, it's really nothing too dramatic. It's no more than we saw in several times in 2012. It's just part of the normal sort of cycle, and I'm not too concerned about what's happening with that VIX index. Now let's have a look at the S&P on the week. It ended up rising 14 points, and as I said at the start, I believe the strong odds are that this correction bottomed at 1560 and that we're now into a new uptrend. Now it might muck around a little bit for another week or two. May not necessarily just start going straight back up, but I believe it has bottomed. And on Friday night we certainly saw some good reversals from large stocks that had been oversold, stocks like Apple, etc. So let's have a look at the S&P index. So this is the chart we've been looking at now for all year. We dropped out of that trend channel, which of course ultimately had to happen. You get an advance, a small decline, 2 steps forward, 1 step back, 2 steps forward, 1 step back, and then eventually you get a bit more of a correction of that whole move. 1556 was my target. That was the 38.2% retracement level. It got to 1560, so got within 4 points, and I believe all signs considered that we're probably have seen the bottom there. Now let's just have a look at the broader Russell 2000 index, the small and mid-cap stocks, because this really does tell us a lot about the breadth of the market. And as you can see, if this was going to develop into a larger correction, as a lot of commentators are talking about, the small and mid-cap stocks, they'd be down here somewhere. I reckon they would be down, they'd be down around about, probably down around this level here somewhere. They would have formed new medium-term lows if this bull market was finished and we were heading into an extended decline. Instead, they're close to their highs. So that's one of several reasons why I don't believe the US market is going to go into a protracted decline. You just see it in other markets. Now looking at the ASX 200, we ended up rising 64 points on the week, and I also believe there's a good chance the correction here ended. We formed a double bottom, about 4,600 points, largely through the support of the banks. There is a bit of a wild card, of course, is what the overseas hedge funds are doing, and they were actively selling all of our large stocks. So we're not completely in control of our own stock market, and that may still play out in a strange sort of way. But look, I don't trade the index and I don't trade the large stocks, so I'm not too fussed about that. I focus on the best quality stocks I can find on the market, and I just focus on trading the patterns or investing in the patterns on those particular stocks. So let's just have a look at the ASX 200. So you can see much bigger correction than what we saw in America. We had support at 46.84. We did get to a low of 46.60, and we had further support at 46.14. So it's in between, but as I said, it's not really that important. I really just look at the ASX 200 as a bit of an indication of sentiment, but not to any great extent. So what to expect in Australia? This is the same slide I put up last week, but it just bears a reiteration again. Large yield stocks are into a broad trading range. Don't expect to see new highs in the banks because they've been pushed up too high. It's the place to be is selected niche sector stocks in healthcare, telecommunications, etc. That's the place to be. And there's also some outstanding turnaround stories starting to emerge. You've got to dig pretty hard to find them, but there certainly are some pretty good ones. Now, of course, the big move which I think has occurred on Friday night is I believe we've seen a reversal in gold stocks. It's been a long time coming, and we will only know for sure when we look back in a couple of months' time, but look, certainly very positive signs. Now gold had another shocker of a week, finished down $63, and if you like, it was the second crash that we've seen in gold. It was really very sharp falls. But I really believe that gold stocks reversed on Friday night in America, and we actually saw some tentative signs in a few gold stocks here on Friday as well. So let's just have a look at gold. So gold on this is gold on a weekly chart. Now we had support at 1302. We crashed straight through that. Our next support was 1156. And that was really quite a big picture support level. You can see that was the full retracement of the whole run that started at $700 in 2008. So 1156, 1157 was the target. We formed a low of 1191. Now so it didn't quite get there. We might have a bit more downside in gold, but you can see even on a weekly chart that the RSI on gold is way oversold now. Let's look at it on a daily chart, however, and you can see quite a positive night for gold. But I was actually watching the market on Friday night, and I can tell you that the gold stocks actually turned up before the price of gold did. Now let's have a look at gold stocks. We'll look at GDX. So you can see here it's just been an unbelievable decline for the last couple of years, and it's only preliminary. Of course, it's only one session, but look at the price volume. Look at the price spike. It was bigger than anything we've seen on this screenshot, and look at the volume as well. Significant volume coming in from oversold. So that's the best indication that we've had yet. Let's have a look at the junior index. Also quite a clear-cut turn. You can see the volume on the last two sessions, even the Thursday night session when gold was falling heavily. Gold stocks didn't. They actually went up slightly. So that was a pretty good indication. Now let's have a look at the chart where we're comparing the GDX with the actual gold price. So we've been looking at this chart all year, and again, nothing definite yet. We'd need another couple of weeks of sustained outperformance of gold stocks, but you can see just how sharp that move was on Friday night. And the final chart I want to look at is the chart of silver, because silver has been absolutely monstered as well, and very sharp turnaround in silver also. So preliminary, but certainly some good signs for precious metals. Now copper slipped to $3 during the week, but then steadied and closed about $3.10. Oil was looking better at 96. This is the copper chart. And so finally, just summing up, and again, this is just a restatement of the same slide from last week. We really got some outstanding entries in the last week, and as I said last time, the best of the best stocks don't stay down for long. You need to know what they are, you need to know what a good entry price is, and you need to pull the trigger on it. So a lot of those stocks have started moving higher again, and gold stocks really look poised to rebound. At this stage it's very early. We're only basically one day into what is probably a turnaround. That makes it high risk, but I can tell you potentially very high reward as well. So that's it for this week. Cheers.